Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, is gold trapped? Is it trapped in a long-term trading range? Here to answer that question, hopefully, is Jeff Nichols, who's the senior economist for Rosland Capital, senior economic advisor for Rosland Capital. Nice to have you back again.
Mike, nice to be here.
Trading range, trapped. The thing about gold, let me just say, it always seems like you get this, one big burst that lasts for a short period of time. Everyone comes running in there, and then it just goes dead for years and years and years. Is this the same story playing out once again?
I think it's going to be a little different this time around. We will have
it's
everybody.
It's different this time. We've never heard that.
We will have
before.
People rushing in, and prices in a 3 to 5 or 7 year time frame will go to record heights that people couldn't believe today.
What do you mean couldn't believe? Are you talking about 5,000, 10,000?
I'm talking about 3,000, 5,000, 7,000 in that range. And the reason being that physical demand has remained strong throughout this bearish period of the last couple of years. The demand has been in China, it's been in India, it's been from central banks. It's not going away, and this gold will never come back to the market. People in those countries are buying it forever to give to their children and their grandchildren and so on.
Yet it still exists. It's out there. You don't burn it up like oil. Every single ounce of gold that has ever been taken out of the ground since the beginning of history, the beginning of time, is out there. Now, you talked about demand, and okay, granted, demand remains strong, but that's only one part of the equation. You got to talk about supply. And, we know above ground supply is there. It's always going to be there.
Above ground supply
and how
is
about,
in very strong hands. It's not coming back anytime soon.
What about new production?
New production isn't significant in the equation, really. I mean, think of it, and we're here at the New York Stock Exchange. Think of it as shares in some stock. The supply of those shares doesn't necessarily go up, but the price of the stock goes up and down depending upon sentiment, really, and expectations about, in the case of equities, future earnings.
Well, many stocks, many companies also pay you something to hold that stock. You're talking about dividends. You're talking about the compounding of earnings, which leads to an appreciation of the stock price. You don't
But
have
people
that
who
with
invest
gold.
in gold have an expectation that over time, over the long run, it's going to retain its value and move higher in opposition to many other financial assets which won't preserve wealth over the years to come.
But is that rational? And I'm just playing the devil's advocate here because, if you look at gold's price, even if you look at gold's price when we hit $1,900 an ounce, when was that, in 2012? Wait, it adjusted for inflation, it wasn't even at the peak of when it hit $850 back in 1980. So, how did it hold its value?
Let me just say, I think it's irrational not to own gold. It's an insurance policy, it's a hedge, it protects the people who own it against all sorts of financial and political risks. And many of the people around the world are subject to risks that we never think of here in the United States. And that's the reason many of them hold gold. It's a cultural phenomena, it's historic, in some countries it's even a religious phenomena.
So the frame of mind of an investor who buys gold, according to what you're saying, should be to just kind of sock it away and have it, and as a long-term hedge. Is that correct?
It's an insurance policy that you hope you will never collect on.
Okay, like a fire insurance policy, a homeowner's insurance.
You don't want
your home to burn down.
You don't want your home to burn down. So the insurance provides a little benefit if it does. Same with gold. You don't want the stock market to drop suddenly and have a major bear market upon us. It may not. But if you own a little gold, physical gold, you've got some protection against that type of market action.
Now, what's, in your opinion, the best way to play the gold market? I thought one way to go about it, which was quite interesting, was with option spreads, bull call spreads. which basically almost pay for themselves. And the good thing about that is you get some leverage. What do you think?
Let me just say that financial and financial games, if you will, may be appropriate for some investors and some speculators, but that's not what I'm talking about. I'm talking about having the real thing hidden in your safe deposit box, literally under your mattress, and just sitting there with the expectation that you're never going to need to cash it in. And
gold bars, coins.
Gold coins, like the American Eagle, the Canadian Maple Leaf, the Austrian Philharmonic, and a number of others, are 1 ounce pure gold coins. They're easily recognizable, they're hard to counterfeit, they're easy to pass along to your heirs. It makes a lot of sense for 5 to 10% of your financial or portfolio exposure be
10%.
5 to 10%.
Okay.
Now, if you've already got that and you think that there's going to be a bull market in gold, you can go ahead and buy more, but that would be for trading purposes, not as an insurance or hedge.
Now, shouldn't investors use periods like this, because you're really looking at it, if I listen to what you're saying, and the long term looks positive for all these fundamental reasons, you really want to buy it when it's on sale, and it's on sale when the price is down.
It's on sale now.
Right.
There's, in a sense, never been a better time, and now is the time to buy gold because its price historically will prove to be very attractive at current levels. And in fact, if you already own a lot of gold, you should just as be happy if it goes down for a while so you can buy more at a lower price.
I know you can't, foretell the future, but in the near term, let's say, is there something that you see potentially as a catalyst which could get the market going? For example, a lot of expectation this year about a change in monetary policy by the Fed. Would be the first time in 7 years that we might see a hike in interest rates. Would that be, for example, a catalyst?
What really counts for gold are not nominal interest rates, but real interest rates. So I think what we'll see in the next year or two is the start of a rise in nominal interest rates, but it will be exceeded by the rise in inflation over the next couple of years. Not that I'm expecting any great inflation, but now it's zero, literally, and it's likely to creep up a bit. And that will counteract some of the rise, or all of the rise, in nominal rates. In the late 1970s, rates were in double-digit territory, but gold went to records never seen before. I think we'll see the same thing happen in the next few years.
Well, I think you're saying something which I totally agree with. I'm not sure if most people understand this, but a rate hike really equates to a fiscal injection on the part of the government. They're paying more interest to people. That's more money flowing out into the economy. That's the proverbial more money chasing, the same amount of goods. That does drive inflation. I don't think a lot of people understand that, but you're correct in that.
Well, for many people, the cost of finance for their car loan or their mortgage or their home improvement loan, that's a cost, just as if it were
exactly.
Retail sales. It may not be counted as retail sales. It's counted as something else in the accounting framework, but we have to pay it, and it comes out of our pocketbook.
Everything hinges off of that. That is the price that is set by the monopolist, which is the government, and everything else hinges off of that. When they raise that interest rate, it is in effect a price increase across the board.
Every time I go to the supermarket, I see higher prices. I don't believe the government is conspiring to fix the consumer price index, but I do think it's an inaccurate indicator of really where inflation is.
But to be fair about it, a lot of things have come down. You could buy. Look at computers. You can't eat your computer, but it makes us more productive. So ostensibly, we end up making more money if we're more productive. I don't know how true that has, that linkage has been, but that's the way it's supposed to work. It may be that the
computer is cheaper today than it was a few years ago.
A lot of things.
But you pay the ISP and the cable company.
There you go, the cable
And,
bill.
you know,
is always
these things
going
are going up.
Tell me about it. All right, Jeff Nichols, always great to have you.
Nice
Thanks
to
very
see
much.
you.
Nice to see you. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.